اللي هي الجلسة الخامسة للمؤتمر تحت عنوان التمويل الإسلامي، أدوات الاستثمار المشترك والدخل الثابت. اسمحوا لي بداية أنه نستدعي السيد فولفانج أنجل، المدير العام لمنطقة الشرق الأوسط وإفريقيا، معهد التمويل الدولي IIF، وهو مدير الجلسة. مايكل جرافيتي، رئيس جمعية الخليج للسندات والصكوك GBSA. بعد الصورة طبعاً. Thank you. وأيضاً أنيتا يداف، رئيسة قسم أبحاث الدخل الثابت بنك الإمارات دبي الوطني. دكتور عمر الجازي، عضو فخري بالمركز الإسلامي الدولي للمصالحة والتحكيم. قتيبة حوامد، المدير التنفيذي العربي عربي انفست AB انفست. سيسيل سين، خبير قانوني أول مجلس أسواق المال في تركيا. أهلا وسهلا بالجميع. Welcome.
Good morning, ladies and gentlemen. First of all, I would like to congratulate the Union of Arab Securities Authorities for the excellent conference which we are all enjoying here today in beautiful Amman. I would also like to welcome you, the audience, to our panel discussion on Islamic finance, investment schemes, and fixed income instruments. The colleague was already kind enough to introduce the panelists, so I can spare that and we can go right into medias res. Ladies and gentlemen, as you know, the Islamic finance markets have all seen substantial growth over the last couple of years globally. Many countries, many banks, many corporations have issued large amounts of bonds and also sukuks. And one of the particularly impressive transaction was Saudi Arabia, that has issued the largest ever emerging market debt issue. Over the last couple of months, there have been a number of positive developments and several good news as far as the Islamic finance market is concerned, which now has reached a volume of $2.4 trillion globally. And the market is expected to reach and actually to exceed $3.5 trillion in 2025. Let me give you a couple of examples what we are seeing in the Islamic finance markets globally. Indonesia, the Indonesia Stock Exchange has introduced ID Islamic, which is a new concept for integrated Islamic capital market development. In Bahrain, the Sharia Bureau confirmed the extension of Sharia compliance, and particularly there the compliance certification for an open source distributed hybrid blockchain. So innovation clearly happening there. The Islamic Development Bank plans the establishment of an Islamic social finance center. In the UAE, the central bank has made it mandatory for all Islamic finance institutions which are active in the UAE to comply with AOFI Sharia standards. Our members, the IIF members in South Africa, are increasing their lending and project finance activities in Islamic format. Pakistan is also strengthening Islamic banking and finance education. Nigeria is introducing and has introduced legal reforms which are supposed to boost the market for Islamic mortgages. And Qatar just announced that they will establish the world's largest energy bank, and it will be fully Islamic. And Saudi Arabia also plans to implement a new zakat mechanism in 2020, which is supposed to improve transparency and also capital market development. And last but not least, no market would function without the involvement of Silicon Valley. A Silicon Valley institution plans to tap the Muslim market with Sharia-compliant blockchain protocol and digital currency. So overall, a lot of very positive news and also very good developments. All these factors will support the Islamic finance markets. So the question, of course, is what are the challenges? And in our panel discussion today, we'll focus on the problems, we'll focus on the challenges and also the opportunities ahead. Anita, let me start with the first question to you. Our colleagues before, and I also just mentioned that the Islamic finance markets have been growing strongly globally. Roughly $2.5 trillion globally has been reached. However, when we look at Islamic finance asset management market, this is a market which has not been growing much. It has been around $80 billion for quite a number of years now. What have we seen in this market, and why have we not seen more growth there? And what are the steps you would like to recommend?
Thank you, Wolfgang. You're right. The whole list of how the market has developed over the last 2 decades that you just shared with the audience was quite impressive. But to put it in context, Islamic finance still represents less than 2% of the global financial markets. Yeah. So it's small in scale. We can say that in the last, this growth has come over the last 2 decades, whereas the conventional finance has been there for 2 centuries. So yes, it's all relative. But particularly for the asset management industry, you mentioned asset management AUM is about 60 billion. Look at it in context of the conventional assets, as per a Price Waterhouse report last year, were 64 trillion. So while Islamic finance is 2% of the global finance, the asset management is only 0.1% of the conventional asset under management in the asset finance industry. Why is the growth in asset management lower than the rest of the Islamic finance progress? It partly comes down to the key fundamental factor that supports growth of asset management, basically the demand. Where does the demand come from? Where do those assets which need to be managed and invested come from? In the conventional market, if you look at, it's the insurance and the pension money which creates the bulk of the assets that get invested. In the Islamic space, particularly it comes from the Islamic faith region, which is dependent on oil, where the markets are still evolving. The insurance industry and the pension industry are very small. I give you an example of the Middle East in GCC. The insurance industry barely has any life insurance in it. It's basically your car and content kind of insurance. Very short duration, and the penetration is less than 10%. If there is no insurance industry, there is no insurance money to be invested in, obviously it stunts the growth. The second factor, the pension. A lot of the Middle Eastern countries have a sizable expat population which probably doesn't take life insurance. Also, life insurance is in a way has a speculation element in it, because you're saying I'm going to die, so I want to protect myself. And speculation is a word that needs to be managed quite articulately under the Sharia law. So even the life insurance, the pension take-up in the region is lagging. So life insurance is lagging, and the government mandated pension schemes for people are lagging, so the pension money is also not there. The third thing is, if the demand, the institutional demand is not there, obviously the product innovation has been limited. So the product innovation is also not there. That is not to say that the growth hasn't happened. If we look at, in 1996, there were 40 Islamic funds. Today, there are about 1,200 Islamic faith funds in the world. So in terms of the number of funds, the growth is impressive. But most of those funds are less than 50 million in value. The overall total amount is less. So where is the bulk of the money from the Islamic region? A lot of it is in the sovereign wealth funds. If the sovereign wealth funds were to direct their money towards investment into Islamic faith funds and products, I think that would boost the growth of the industry. So otherwise, right now, I think those 3-4 pillars where the product innovation is missing, the demand side is missing, the government money is not being invested, that pillar is missing. It's all what is contributing to the slow pace of growth in the asset management industry and Islamic products.
Cecil, you are the senior legal expert at the securities market regulator in Turkey. Let's take a look at the country. What are the recent developments in Turkey for sukuks and also for collective investment schemes? And particularly, where do you see the challenges to see further growth and further development?
Thank you very much. First, I would like to thank Union of Arab Securities Authorities and Jordan Securities Commission for the excellent organization and the invitation for the panel discussion. I'm glad to be part of it. For the question in Turkey case, for the collective investment schemes, to start with, which is vital for capital market formation, channeling long-term funds to the real sector, which is very valuable in terms of creating producive capital, which is financing infrastructure investments, SME finance, which provides patient capital, and which is more engaging capital for the betterment of corporate governance practices, valuable for the development of capital markets. Though in our case, I would say the mutual fund structure introduction in Turkey was back in 1987. ETFs is in 2004. Pension funds was introduced in 2003. It is more than a decade, 15 years. And all asset classes, collective investment structures are in place. Though, despite all these things, the total net asset value of the market is less than 5% to the GDP, Turkey's GDP. This means there is much room for improvement for Turkey's collective investment markets, and broadening the collective investors, and also the diversification of the products is a strategic issue in the capital markets boards from a regulatory perspective, the strategic plan in 2017-2021. To overcome the challenges, at least from the perspective of the regulator, we are looking for the possibilities of fintech on crowdfunding, market-driven financing, and also there is a electronic trading platform for funds, all funds operating in Turkey, which is hoped to ease access to markets for large amount of investors, comparing the performances, accessing information. For example, trading on foreign currency in this market is an objective. Also, supporting the framework for interest-free financial instruments, how we call Islamic finance instruments, SKUK, mainly in Turkey, like that. These three tools for policy is designed as overcoming the challenges in Turkish markets. So it takes time for in advanced markets as well. They have favored the role of institutional investors. However, it is slow to develop. But tapping this potential within its very vital. And Islamic finance, fintech, collective investment schemes are part of the policy, which will in a way combine and support each other. Thank you.
Michael, when we look at our region, I think it's fair to say that the dollar, the dollar plays a very important role here. A lot of currencies are pegged, and the large projects are pretty much all done in dollars or in euros. Even the currency allocation of the large portfolios in the region, the sovereign funds, sovereign wealth funds, are predominantly in dollars and in euros. From the market perspective, there is no doubt that we need to establish, we need to develop local currency markets. From your perspective as the president of the Bond and Sukuk Association, what have we done so far? What has been achieved? What are the challenges and what are the opportunities and what are the headwinds we have to remove?
Thank you, Wolfgang, and thanks also to the UASA and Jalil and team for having us participate in this great event. Our organization is representing the Middle East and especially Gulf debt capital market, which is a very critical market, and our members, many of whom are here, are coming from the buy side through to the issuers and everything in between: service providers, ratings agencies, banks, investors, and so on. And so we have a fair overview of the market. As you alluded before, Wolfgang, the Middle East and especially Gulf bond markets have arrived in size. They're now placing, Saudi has placed the largest emerging market bond ever. Supply since 2015 has increased from a kind of a level of 30 billion or so in dollars, and mainly dollars, up to 60, 80, 100 billion, and this is now the sort of fourth year of this. So this has been recognized. It's a great accomplishment. Sovereigns have been issuing, banks issuing, greater diversity of issuers as well. Inclusion recently of certain markets in the global emerging market bond indices run by JP Morgan has been a recent backwind, let's say, as well. What is still behind, lacking a little bit, and there are some reasons for this, are the local currency markets, the markets that we work on as well with our regulatory partners. And I'll try to shed a little bit of light on that. First, I'd just like to say a deep thanks to all of the regulators with whom we work, who have really fully understand the distinction between equity markets and fixed income markets and the special needs of fixed income in terms of disclosure. We've had lots of accomplishments in order to remove obstacles to companies coming to market, making it easier, speedier to come to market, creating certain exemptions for certain kinds of companies and certain investors, high net worth investors, qualified investors, and so on, all of which are steps along the path. The over-the-counter nature of bond markets is largely recognized, while bonds can and should be listed on exchanges, not necessarily to be traded there, according to global practice. Regulations on special purpose companies have been made, but the local markets still remain small, fragmented, and not liquid enough. We don't have enough issuers coming to market. Especially, as I think is mentioned in the previous panel, the large family-owned companies, neither listed for equity and mainly for debt. We have some very successful stories among them. Those who obtained ratings and found great benefits from tapping different debt markets. The capital market regulators, having done their bit, you can say, I think we need to move towards integrating some of the other stakeholders to address some of the economic obstacles to developing the market. For example, pensions and insurance have been mentioned. I think that's, there's going to be a limit on how far we can go before we have pensions and insurance really participating in steering the market, that kind of local institutional investor base. Central banks, I think, need to be more involved as well. This is not just a matter for the capital market regulators. When we want to, some of the potential sources of new issuance may include things like securitization. We've got great cash flows existing in the economies which can be securitized, some of which may be based on government receivables, for example, out of which Sharia-compliant commercial paper could be created, and this sort of thing. But these need a wider set of stakeholders and kind of a development of a debt capital market development plan in the countries as well. We also look at things like covered bonds as having a potential. Convertible bonds also we know would have a great demand. And project bonds, of course, to help start to address some of the infrastructure needs. I'll probably just leave it there. I think there's probably more to come.
Thanks, Michael. Omar, you are the managing partner of your law firm. You are also the honorary fellow of ICRA, institution which plays an important role. You have been involved in Islamic finance for many years, and you have also advised many banks, many asset managers. And you were also involved in the drafting of the integrated Sharia standard rules and procedures for the settlement of Islamic financial disputes. A year ago, we had the Dana gas case in the UAE, which has clearly shaken investor confidence in Islamic debt, not only in the region, but globally. From your perspective, what needs to be done on the legal side, on governance, and on the regulator side to restore investor confidence fully?
Thank you, Wolfgang, for having me today. I'm honored to be among friends, friendly faces. I'm invited today as a fellow, honorary fellow of ICRA. Therefore, if you allow me just to give you like a brief introduction on ICRA. ICRA is the International Islamic Center for Reconciliation and Arbitration, based in Dubai, hosted by United Arab Emirates. It has been established by virtue of an agreement, the General Assembly of ICRA, composed of 70 Islamic financial institutions. Its primary goal is to serve its clients by settling the disputes by conciliation or arbitration in accordance with Sharia. They have a very prestigious Sharia board, which exercises its role as a court to verify any arbitral award to be enforceable at law and to be in compliance with Sharia. I'm honored to be the honorary fellow in Jordan representing them. My understanding that yesterday they have signed the MOU with the Arab Union for securities authorities, and we are in the process to open a branch in Jordan to be hosted by the government of Jordan. Going back to your case, most of you are aware of what happened with the Dana gas. Dana gas dispute has reached the London High Court for several reasons. And I think the main reasons is the shifting opinions among scholars. Dana gas has rejected the request by its creditors, and I recall it was sold, the first bond was sold to Goldman Sachs, I think, and BlackRock. And it has rejected the offer requested by its creditor to reschedule the $700 million debt due to the shifting opinions among the scholars. Anyway, this case is not without any precedent, because there was the Kuwaiti firm, which is the Investment Dar, I recall, the Investment Dar, which has sold its bond firstly to Bloom Bank, I think. It has rejected as well to restructure its debt based on the same argument. Therefore, my humble opinion that to avoid such a case, Of course, the effect was severe, Wolfgang, we have to agree. And it has created some chaos and some lack of confidence. But I think the main thing that we need to work on more raising awareness and to make the distinction between sukuk and the fixed income assets. This is the most important thing to avoid further complications.
Utaiba, you are the CEO of the investment management firm AB Invest. From the perspective of an investor in Islamic finance market, what makes the markets attractive and what are the points where you see room for improvement? And I have a second question for you. From as far as compliance criteria is concerned, do you think that we have clear and transparent Sharia compliance criteria across the sector?
Yes, thank you very much. I mean, we've been through this market for the past 15 or 20 years in AB Invest. We're a MENA-focused asset manager, and we invest on conventional and on Sharia-compliant basis. So we've been basically through the ups and the downs in the past 15 years. One of the things that was mentioned in respect of the growth in the Sharia or in the Islamic finance landscape, I think partially it was also the significant drops that have taken place in the market. So, you know, when markets go down, whether you're a conventional or an Islamic investor, you tend to invest less probably. But going back to your question, I think it's, we've also seen other cases of, you know, without talking about specific names, but we have seen cases of non-default or default or non-performance by Sharia-compliant borrowers in the region. Whether it's sukuk or murabahas or something else. And I think there was a lot of confusion when that happened, because in some countries, in some markets, the lenders or the investors could not actually execute or get their hands on the assets underlying those securities for various reasons. It could be regulatory, it could be operational, and so on and so forth. The other thing is the confusion over the Sharia compliance criteria. So we've seen in some cases the issuer itself saying that these securities are now non-Sharia compliant, and they have used this excuse so as not to settle or not to pay off the amounts they have received. So, and I think this creates a significant or a fundamental need to re-examine very closely the operational and regulatory frameworks under which these securities or these instruments are issued and marketed to the public. I think it's very, very important to try to refer to a single point of reference when it comes to Sharia compliance and to the criteria that makes certain instruments Sharia compliant or not. Because many investors are not or may not really have that kind of sophistication when they invest in Sharia compliant instruments. They just, you know, follow the lead that this is marketed as a Sharia compliant or Islamic compliant instrument, and they just buy into it without really knowing if it's actually or theoretically at least, if it is compliant or not. So this is one thing. The other thing is, and I think we've seen this, I've seen it, you know, a few years ago, where service providers of Sharia compliant or benchmarks or indices, these providers also do not have fundamental or basic or clear understanding of the Sharia compliance criteria for inclusion or exclusion of certain securities or sectors within the index. So we've had a case, for example, with one provider who included a weight of 50% for a single stock in an index. And then when we started questioning them about the rationale and about the Sharia criteria that they have used, they went totally blank. They couldn't even answer, the very basic questions that we asked. And they had to take that, roll back that product eventually. So I think there is maybe a lack of clarity when it comes to Sharia compliance, and which really what drives demand. Investors who want Sharia compliant products, they may be foregoing certain diversification benefits. They may be foregoing certain a portion of the expected return. They may be, maybe more concentrated in certain investments or certain sectors or countries, which adds volatility to their portfolios. But what they are genuinely asking for is compliance. So, as providers, it's really important that we do our best to make sure that what we are really offering them is Sharia compliant. I'm not sure what the second question was.
Sorry, the compliance criterion. Do you feel that we have standardized, open, transparent criteria across the market, starting from one market and then, of course, looking across the markets?
Yeah, we've seen a lot, massive improvement from in terms of regulations that govern the offering, for example, of funds or investments to the investing public, especially to retail. And these improvements have covered, not just disclosures or certain disclosures or suitability or representation and so on and so forth. But I still think there is a lot of room for improvement. For example, some funds today are able to rebrand themselves. They can rebrand themselves and relaunch the same fund which has been in existence, for example, for 10, 15 years, just to cover or to disassociate certain periods of weak performance. For example, this is not disclosed, for example, because they are in the market, they are offering a new product supposedly, but it's actually a continuation of a past product or an older product. So doing this will give the wrong message to investors. To potential investors who don't know the history will get misrepresented, they will get misguided, and they will end up investing in a fund without getting the full picture or the full knowledge. I think it's very, very important to make sure, these small things can make a lot of difference when it comes to raising integrity and transparency and disclosure. In some cases, for example, a fund or an asset management company may have key people in it or key fund managers, which attract, certain or many investors. So it's really important that when these people leave or change, or the ownership, for example, change, or when the decision-making process for investment changes, that this information be disclosed to investors so that they can assess whether they want to stay, with a certain fund or a certain manager, or to move on to another. The other thing is also benchmarking. So in many cases, many funds in the region compare their performance to certain benchmarks, and they publish and market themselves as super stars, or they say that we have outperformed certain benchmarks or certain indices. And this is also not as simple as this. There is also a lot of fundamental science behind choosing a specific benchmark to which you can compare performance, and it has to be also taken in the framework or under consideration of the risk involved, so that not only nominal performance is compared, but also the amount of risk taken by the fund manager. And this kind of this small piece of information is very, very critical for potential investors, especially the retail investors, who may be misguided or misled by a fund manager which outperformed a certain benchmark, but has assumed substantial amount of risk, or was maybe just lucky at one period or another. Thank you.
Anita, let's take a look at innovation in Islamic finance. From your perspective, how can fintech and also the whole range of technology and innovation there unlock new opportunities for growth, and to which extent can it disrupt the whole Islamic finance industry? And in this context, another question: do you think there are blockchain applications possible for Islamic finance?
This question could actually equally apply to even conventional banking, as to what the innovation in fintech, how much disruption is it causing to the traditional banking systems and methods. But specific to Islamic finance, there are things which have happened which are quite pleasing to see, and there are others where maybe the evolution could have been a bit better. So as per a recent survey, the internet banking, the customers of Islamic finance, more than 50% of them are actually unhappy with the kind of simple internet banking offering from their banks. So Islamic banks have lagged in that adoption slightly than the conventional. And why is that? It's partly because I think the profitability of Islamic banks is much weaker than the conventionals. So you need money to invest in innovation, to fintech and internet and all. It needs investment of money. And if the profitability is low, then they're not going to have that extra money. Why is the profitability low? Is partly because economies of scale. So if I take an example of UAE, UAE has 49 banks. 3 big banks take nearly 50% market share. The remainder 46 banks are the sharing rest of 50% market share. You can imagine each bank's percentage share of market is reasonably small. Within that, if you focus only on Islamic banks, it's even smaller. With small economies of scale and lower profitability, their ability to invest in internet and all those products is less. Having said that, if you move outside the banking space and you look at the new firms which are coming up, non-banking, fintech-focused firms, and what they have launched, we are seeing quite a bit of progress on, likes of the blockchain providers from Silicon Valley, like Ripple or Stellar Technologies, who have come into the region, who are working with Islamic banks to give them access to the blockchain facility, or even this Stellar Technologies has actually received a Sharia certificate for an Islamic cryptocurrency called Lumen. We've seen the likes of Al Raji Bank in Saudi. I mean, Saudi and Malaysia obviously are way ahead in Islamic finance than others. Al Raji actually did a transaction with this Jordanian unit using blockchain technology nearly 2.5 years ago, in 2017. It's quite pleasing to see that they are at pace in terms of adopting the blockchain and cryptocurrency at pace with the conventional bank. In fact, SAMA, the Saudi Monetary Authority, and Central Bank of UAE have recently signed an agreement to use blockchain for inter-country transactions. So as the adoption of blockchain or cryptocurrency or the newer technologies gets taken by the conventional banking, I think Islamic banking is pleasingly keeping pace on that front with them. Yeah?
Cecile, in addition to your role as senior legal expert at the authority in Turkey, you are also in charge of the Secretariat of the Capital Markets Regulators Forum, COMSEC. COMSEC conducted a survey in 2018, and if I'm correct, it was under the lead of the Kuwaiti CMA. Would you be kind enough to share with us the findings? What are the conclusions and what are the proposed next steps?
Thank you. Let me start with what COMSEC stands for, if you like. COMSEC is the Standing Committee of Economic Cooperation Committee for the OIC, Organization for Islamic Cooperation. The organization has 57 countries, as you know, and the COMSEC Capital Market Regulators Forum is the platform for financial cooperation for regulatory capital market regulatory authorities of OIC countries. It was founded in 2011. It's kind of sister organization for Union of Arab Securities Authorities with the same objectives, I would say. As you say, Capital Markets Board is the secretariat and the chair of the platform. Though it is a fully collaboration initiative, we are operating with 4 task forces led by on Islamic Finance, Malaysian Securities Commission, on market development side, Kuwait Capital Markets Authority, and on financial literacy, Iran Securities and Exchange Organization, and on financial capacity building, Capital Markets Board of Turkey. We have been working on various initiatives, and as you say, in 2018, Market Development Chair, Kuwait Capital Markets Authority has conducted a comprehensive survey for the COMSEC countries' CIS markets, collective investment schemes markets. It's an overview of the countries' practices, and it wanted to make a summary for the challenges and developments ahead. According to the survey, the legal structures for CIS in these countries, of course, assessed, because it is very relevant with the investor protection, whether it is a contractual fund, a trust, or an investment company, in terms of distinguishing the assets of the clients or the other entities. That was a finding which forms were favored. By the way, the survey was responded by 13 countries. In Arab geography, other than Kuwait's initiative, Saudi Arabia, Jordan, Kuwait, United Arab Emirates has contributed, Iran, Bangladesh, Malaysia, Pakistan, Turkey, Albania, Tunisia, Maldives were also contributory. So it's giving the picture of, in the regulatory and market facts, the CIS, it's a comprehensive one. Other than the legal forms, for the operating principles for disclosure responsibilities of the CIS, for example, automated reporting initiative trend was asked. It was understood that Pakistan has such a practice, Iran has a similar one, but it's not that wide. That's a new disclosure method, as you know. For leverage risks, which is a critical issue for liquidity mismatch, it was also followed, tracked which countries are on which leverage toleration, what are the risks, and what are the most common violations in terms of regulation. It was found that late disclosure, non-adherence to minimum capital requirements, and limitations on risks was one of the important findings. Also, oversight responsibilities of the regulatories. For example, in Malaysia, it is an SRO, self-regulatory organization, who is sharing the responsibility, or an external auditor is sought in some cases. There is a delegate of responsibility option. Other than that, it was asked, what are your last 2 years launch of CIS schemes in your markets? Private equity and real estate investment funds were the most two recently launched initiatives in the sphere of the respondent countries. Also, ETF is an issue. Most of the respondent members are in planning of launching ETF structures. Other than that, an interesting phenomenon probably launched in UK first, an unregulated CIS for professional investors, not complying all of the set of regulations for CIS. It is in the plan of United Arab Emirates, I guess. They are planning to launch such an unregulated CIS initiative. The fees, of course, was another issue. These were the main topics survey has followed. And for areas of improvement, without any exception, all the authorities have said that investor education is an essential need for liquidity and other purposes. Yes, that was what Kuwait Authority has very diligently provided for us for the forum platform. Thank you.
Michael, transparency and availability of objective and reliable information is probably one of the most important factors for the developments of financial markets. In the region, we know and we see a lot of marketing and PR information, which is all good, but investors need objective information to assess risk and to price assets. And of course, in this context, rating agencies play a very important role in the region, but also globally. When it comes to our region, what is the role of credit ratings? And what have we achieved so far from your perspective as the president of the Gulf Bond and Sukuk Association? What additional steps would you like to see?
Thank you, Wolfgang. Yeah, I mean, we can say transparency, but need to give that some teeth. Global investors have very high expectations and regional investors as well, and they will fix a price to poor governance. Or less than transparent communication. So therefore, we have an investor relations effort. We work with the Middle East Investor Relations Association to go a step beyond the disclosure that is regulated in order to promote the practice of frequent, standardized, not disclosure, but investor communications programs. And we have some great stars in the region in terms of communicating with investors on an equal basis across the board according to principles that we have published. That starts, of course, with the sovereigns themselves, who are now into that practice as a requirement of accessing global markets. The rating agencies have a tremendous role in promoting these excellent practices and a discipline. The number of ratings in the region has increased 10, 12 years ago, the number was really just a handful of rated entities. The agencies, all of the global agencies, are now located within the region, in some cases with multiple offices in different markets within the region. And this is something I think which is very positive. Regional agencies coming forward, Sharia-compliant agencies looking from that point of view. The financial crisis cast a bit of a shadow, we can say, globally on the rating agency model and business. They've become very heavily regulated, particularly out of Europe. I don't think the issues that affected that rating agencies were criticized for in terms of the global financial crisis really were particularly relevant for this region. In this region, we're talking about we've been at a more fundamental level about getting companies out there, getting rated for the first time, and this is fundamentally a very healthy process. I mean, the agencies are flexible, and they begin a dialogue, a long-term dialogue with companies long before, in many cases, from a first inquiry, where a family company, for example, may just be thinking in the future about the market, and they can come and sort of begin a very quiet dialogue and begin to have a feedback from the agencies about what a rating may be, what the requirements would be, and to begin a process. And so we try and work with some of our rated companies to tell the story, with a Majid Al Futtaim company in UAE or a Kipco in Kuwait or others who have a story to tell about this journey, which is a very positive and healthy journey for the development of the treasury and the financial operations and the disclosure, which may or may not lead in the end to, it need not be associated with a bond issue or an equity listing, but this is something which is also very helpful for accessing other kinds of markets as well, globally and regionally. So this is something to be supported. I think there's been a lot of dialogue with the regulators about how, and I don't want to come into detail on some of those questions and debates, but I think that the regulators in the room understand the role, the very important role of ratings.
Omar, another question for you. An international regulatory and legal framework, does that matter for the Islamic finance markets? And from your perspective, the recommendations you have with regard to the adoption of international regulations and particularly resolution regimes in Islamic finance, is that something which should be given more importance, more relevance?
Definitely should be given a priority by uniting all efforts and bring them all under one solid umbrella. And I think we should consider as well imposing or enhancing abiding nature of such regulations and more standard documentations, and to follow the track of the international auditors and the chartered accountants. Actually, they have really abiding nature when there's the lawyer speaking now under me. But I will give you one thing. We need more consensus. In my area of practice, which is arbitration, I just came back from Dubai yesterday. And we had a debate. I took a part of a panel debating the Sharia's perspectives regarding appointing female arbitrators or even non-Muslim arbitrators. And this was one part of my maybe thesis in my PhD. I have written a chapter on arbitration in Islam. But as you are aware, we have 4 schools of thoughts, Sunni schools. And we are really happy that to have His Excellency Dr. Abbadi among us, one of the more long-serving ministers and a scholar that we are very proud of having him here. Maybe he will agree with me that the Hanafi school, which is the Majalla, which is the first Ottoman codification of the civil law based on the Hanafi school, allows appointing female arbitrators, while the other 3 Sunni schools, they have their own limitations or observations. In my humble experience, I participated under ICRA in a major financial dispute, and I have agreed with my fellow co-arbitrator to appoint a non-Muslim, which really enjoyed his leadership. But he was really specialized in Islamic finance. And I'm not going to give you my opinion, but I think we need more consensus on appointing, for example, female arbitrators. Is this allowed by Sharia? Is this something that could be challenged down the road as if it's not enforceable arbiter award? If we appoint a non-Muslim arbitrator, and sometimes do you have the luxury of appointing your own arbitrators? If there's another appointing authority that will exercise this right, and I can give you examples. I think more consensus, more standard documentations, and to override the controversies and disagreements among the scholars as well.
Utaiba, let's take a look at the investor side. There's clearly a very strong demand from banks for sukuks, frequently also issued by other banks. When we look now at the retail demand, globally, retail investors play a strong role in a lot of markets. Do retail investors actually have direct access to sukuk markets? Can they buy sukuks, or are there any aspects we should improve?
Yeah, thanks. I think this is a very important point, and I think it's one of the things that have put the brakes on the growth of Islamic finance in the region. Fixed income and sukuk in general are mostly absorbed by banks. For whatever reason, it could be capital adequacy, it could be diversification, it could be better utilization of capital, and so on and so forth. I think one of the things that could impact this is the fintech, and data revolution happening. Now there's a lot of hype around fintech, and I think there's a long learning curve for many institutions to take to actually transform their business models. But I think it's one of the byproducts where retail investors, no matter how small their capital outlay is, they may end up having better access to different asset classes, not just sukuk, but also Islamic REITs, Sharia compliant private equity, for example. So, which will, help them diversify their saving portfolios and improve the efficiency of their saving portfolios on the long term. And it's also one of the things that could also improve, it was mentioned in previous sessions, that will improve the liquidity in the markets. I think one of the also important things that we also maybe did not mention is the investment culture in this part of the world. So we're talking about regulations, we're talking about products, product providers, markets, and so on and so forth. But we also need to work on the investment culture in the region. It's very, very important that investors make decisions based on informed or on good quality research when they make these investments. And I think this is one of the most important things that could drive liquidity in our markets on a structural long-term basis. It's, a lot of people mention liquidity. We don't need just day-to-day liquidity or liquidity driven by cheap credit or near zero interest rates or by momentum trades. We need structural long-term liquidity that moves in and out of the market based on the economic fundamentals on the investments. And this is what's really what improves. This is what will improve efficiency. This is what will improve the investment culture in our region. Thank you.
Before we take questions from the audience, I'd have one last question for our panelists here. If we look at a lot of markets, we see that several countries globally are considering also to establish Islamic finance markets. This is the case in Asia. This is clearly the case in Africa. We are seeing some trends in the US. The panelists were already alluding to the fact that Islamic finance markets continue to be fragmented, standardization is needed, and Sharia courts tend to look at products and markets differently. So if you were asked now by some of the sovereigns which model they should embrace to move forward with the establishment of an Islamic finance market in a country, in Africa, in Asia, in Europe, or even in the US, which model would you recommend? We have many, the Bahraini model, the Jordanian model, the Kuwaiti, Indonesia, Malaysia. Even in the UAE, as we have seen in the recent case, there are different interpretations between Dubai and Abu Dhabi. So I would like to ask my panelists here just to give me a very short answer, which model you think would be most applicable. Ladies first, Anita.
Instead of picking any one particular model, I think to develop any industry, if you have to develop the markets, the first thing to start would be for the governments to privatize assets. Because once the government privatizes assets, those privatized companies are the ones which will either get listed on stock exchange or are the ones that will issue the debt. Once the stock exchange listing happens is when you can develop the ETFs and everything. Or once the debt issuance requirement comes out is how you can do a sukuk or something like that. So the first thing would be to create the availability of assets, which I think is by privatizing government assets. The second thing would be to create demand, which I think comes from largely the institutional. The retail demand is a separate thing, but retail demand does not move markets. It's the institutional demand that moves markets. To create institutional demand would be to promote insurance and pension. So to me, as long as these three fundamental factors are addressed, then the rest of the things can work around it and markets can evolve. Yeah.
Cecil, your recommendation, please.
For the Islamic finance market models, I recalled in our SCOOC communique regulation, there is the 5 SCOOC structures, you know, the Musharaka, Mudaraba, and there is a Malaysian Middle East hybrid approach, and there is also an open, which the authority will have the discretion to approve, though it's not fitting with any structure. So there is an open door to any innovative type of structuring. This is an approach, in my view, a hybrid one or an open structure, not to closing the door for structuring instruments. And other than that, fintech platformification issues can be the channels for providing liquidity for accessing retail investors. And other than that, other than the fintech global trend, there's another trend actually transforming financial services, which is the sustainability finance approach. In that regard, Malaysia, is leading the green SCOOC, green finance initiatives, and it is backed by World Bank. The agenda is important for UN. EU is publishing milestone approaches for green finance. And green Islamic finance values principles, underlying principles, has a synergy matching with the sustainable asset classes approaches. So these two trends, the waves, can support new market structures, in my view, technology and sustainability. Thank you.
Michael and Utaiba, your short answers, please.
Yeah, I think Islamic banks should be involved more in partnership-based financing. I think today most Islamic banks take the least risk possible when it comes to financing. I think for the future, especially with the SME sector, the small, which make up most of the economies in the region, I think they should be involved more in partnership-based financing to these companies. Thank you.
Just briefly, look, I'll also dodge the model, identifying a model. I'll look at it more from a top-down or bottom-up approach. I don't think for most of the jurisdictions that you mentioned on being the frontier of Islamic finance probably have the capacity or the ability or a captive market in a sense to take a top-down approach and to define how everything should work. I would suggest listening to, if you want to achieve any scale, to listen acutely to the demand, to what investors want, and not just local investors, but global investors who you would want to attract in. And so, I think in that sense, a Gulf regional approach, which is more market-driven, may be more appropriate. And I think ESG and green kinds of initiatives are also very important because I think we haven't really talked about this, the incredible linkages between Islamic finance and sustainable investing. Particularly the benefits of that I think are in the fixed income side. And I think if we can develop kudos to those who can develop fixed income products which are Sharia compliant, which can then tap into the global SRI market, which is much, much larger than the entire Sharia compliant industry, frankly. And that would be a way to exponentially perhaps drive assets and investment into Sharia compliant and Sukuk specifically.
Omar,
I have nothing to add, but to second what Anita stated, actually. I totally agree with what you have stated.
Okay, so let me ask the chairman if we still can take some questions or if the coffee break is forcing us to conclude things. Okay, good. So that gives me the opportunity to thank my fellow panelists for their excellent contributions and thank you, the audience, for your interest, for your attention. Thank you very much.
Thank you, panelists. Thanks.